Thanks for joining me this Friday, the 13th of September. I'm Grady market analyst of Direct, and this is the weekly market update. Economic data has been a key driver of market movements in recent times as investors shift portfolios in response to the outlook for inflation and subsequently interest rate cuts. Expectations of rate cuts are not likely in Australia until 2025, driven by factors including sticky inflationary pressures, including wages, input costs, housing and services inflation. This week, some key economic data painted vastly different pictures about the health and stability of major economies around the world, and we saw starkly different investor reactions to the key data. The week started with the key inflation and trade balance data out of China. Markets in Asia region were sold off early in the week due to China's latest inflation print, with inflation rising 0.6% in August, which is a slight rise from the 0.5% reported in July. But the August reading fell short of economists' expectations. Lower transport and oil prices weighed on inflationary growth, while clothing, health and education also fell on the prior reading. China's struggling inflation indicates the world's second largest economy continues to struggle in its post-pandemic recovery era. China's trade balance data out on Tuesday eased investor concerns just slightly, with a rebound in exports boosting the region's trade surplus. In August, China reported an increase in trade surplus to the equivalent of $91.02 billion from $67.81 billion in the same period a year earlier, and a higher reading than the $84.65 billion reported in July. Economists were expecting a decline in trade surplus to $83.9 billion for August, which the reading easily exceeded. Exports for August in China rose 8.7% year on year to a 23-month high, while imports rose just 0.5%, slowing sharply from the 7.2% jump in imports in July. This indicates increased activity in China, and sales are being realised and leading to higher exports, while imports remain subdued. The expectation for China's GDP growth rate in 2024 has now been revised to growth of 4.5% amid the ongoing slowdown in the region's property market and subdued demand across most industries, which falls short of the 5% growth experienced last year, in the first half of this year, While the government continues to promise a stimulus package to reignite economic recovery and stability of the region, until a material amount is announced and handed down to assist with recovery across all industries, we are likely to see subdued economic activity out of China for a little while to come. Over in the US, markets rallied midweek after key US inflation data released indicated the Fed's aggressive rate strategy continues to work toward taming inflation to the target 2% level, and provided further evidence that the Fed's consideration and likelihood of a rate cut later this month can go ahead. Core inflation, which strips out volatile factors including energy and food costs, in the world's largest economy rose 0.3% in August, while the core inflation rate year on year remained at 3.2%, and the overall inflation rate remained at 2.5% year on year, edging even closer to the Fed's target of 2%. The resilience of the US economy has investor confidence boosted in the Fed's ability to tame inflation while avoiding a recession. Retail sales remain resilient with a 1.1% rise posted in August. Wage price inflation continues to ease with an increase of 4.39%, down from 4.62% reported in June. The employment market remains resilient with the unemployment rate falling to 4.2% in August, down from 4.3% in July, and the US GDP growth rate continues to increase with an increase of 3% in Q2 of 2024, which was a welcome rise from the 1.4% reported in Q1. The Fed is likely to announce, and widely expected to announce, the first rate cut of the interest rate current cycle at the next FOMC meeting starting next week on September 17th. Locally, Australia's consumer confidence and business confidence data moved the local market earlier this week. Westpac consumer confidence data for September out on Tuesday came in at a fall of 0.5%, which was less than economists were expecting of a 1.2% fall, but still indicated a slide from August as consumer confidence confidence was hit by the sluggish GDP growth rate in Australia for Q2 and the overall stability of the Australian economy. Now, business confidence data for August, also out earlier this week, indicated business confidence fell 3 points in August to -4 index points, compared to market expectations of a rise to 3 points. The slide in business confidence was driven by declining employment and cost inputs eating away at margins. Economic data is likely to still move markets until the easing interest rate environment creates economic stability in the future and investor sentiment is boosted by the lower cost environment. Locally, from Monday to Thursday, the ASX 200 posted a 0.78% gain, led by real estate stocks soaring almost 3%, while financial stocks were the only sector to end the week lower. The winning stocks were led by Deep Yellow, soaring 25%, while Mineral Resources recovered some recent losses with a 24.05% gain, and Liontown Resources also recovered some ground with a 20% rally. Steadfast Group, on the losing end, posted an 11.34% decline over the 4 trading days. On the broader market index, the All Ords rose 0.95% this week, led by Melbana Energy soaring 40%, while Appen and Calix added 39% and 32% respectively. The most traded stocks by Bell Direct clients this week were Silex Systems. Clients also bought into BHP, Macmillan Shakespeare, Woodside, Woolworths and Accent Group, while taking profits from Westpac, CBA, PM Capital Global Opportunities Fund and Clarity Pharmaceuticals. And the most traded ETFs by our clients this week were led by BetaShares Australian Equity Strong Bear Hedge Fund, Vanguard Australian Shares Index ETF and BetaShares Geared Australian Equity Hedge Fund ETF. On the economic calendar next week, there is no local economic data out that is key to the economy, but investors' eyes will be on the US retail sales data out on Tuesday, with the expectation of a 0.3% decline in retail spend, while US building permits data is also out on Wednesday, and the highly anticipated Fed's rate meeting kicks off on Tuesday. The UK and Japan will also have their handed down interest rate decisions later next week, with the expectation of the BOE, or Bank of England, to maintain the current 5% rate, while the Bank of Japan is expected to increase to 3% from 2.8% in July. And that's all for this week. Have a wonderful weekend and happy investing.